So saying IAS 40 defines an investment property as a building or land or part of a building or both held by the owner or by the lessee as a right of use asset to earn rentals or for capital appreciation or both. This property should not be one which is used in the production or supply of goods or services or for administrative purposes. Neither should it be a building held with the intention for selling purposes. Once that definition has passed, we then have to measure, we then have to recognize this intangible, this asset. An investment property is recognized when and only when it is probable that the future economic benefits that are associated with the investment property will flow to the entity, and the cost of the investment property can be measured reliably. After recognition, we measure the asset, the investment property. Just like IAS 16, the investment property is first measured at recognition. At recognition, it is measured at cost. The same cost that we looked at, the same definition of cost we looked at under IAS 16 applies also to under IAS 40. The investment property will be depreciated over its useful life, just like IAS 16. Then you also have measurement after recognition. The standard allows an entity to either continue with the cost model as applied in IAS 16, cost less accumulated depreciation and impairment losses. Or the entity can choose to use the fair value model. Just like under IAS 16, if the entity chooses to use the fair value model, you cannot be selective. You have to revalue all investment properties that you have. Now, if you choose the revaluation model, that is where the differences now come in from IAS 16. If you revalue an investment property, the investment property is measured at fair value at the end of the reporting period. Any resulting gain or loss will all go to profit or loss for the period. Okay. Take note the difference with IAS 16. Even after revaluation, the gain will go to revaluation reserve. Okay, but investment property, they all go to P&L. The other difference is that with an investment property, once you revalue it, you stop depreciating it. whereas I-16 you continue depreciating it over the remaining useful life. Clear? Okay, that concludes IAS 40. Any question? We move to another standard, IAS 23, borrowing costs. We touched on borrowing costs briefly when we looked at IAS 16. Borrowing costs, as we defined earlier on, these are costs, basically interest, which you pay when you have borrowed money. But in this case, the borrowing costs that are directly related to the acquisition, construction or production of a qualifying asset must be capitalized as part of the cost of that asset. Okay. Again, the word qualifying, we emphasize, never leave out the word qualifying in your answer. You need to know what qualifying asset is. This is an asset that necessarily takes a substantial period of time to be ready for its intended use or sale. Now, there are two types of borrowing costs which are eligible for capitalization. There are costs borrowed specifically for a qualifying asset. Both borrowing costs borrowed specifically for qualifying assets should be capitalized to the extent. Now, let me give you an example to amplify what the standard requires you to know here. Let's assume you borrow 50 million. Are you going to buy all the materials for 50 million? No. Because you take 50 million worth of materials to the site, you find half of them have been stolen. So you buy the materials enough for what is required. Now, if you are a good finance manager, you are not going to let the money sit. You'd want to earn some interest from that money, right? The rest of the money. So you invest that money. Now the standard then says if you invest this money and made some interest for yourself, then the interest that you capitalize should be net of the interest that you have earned for yourself. Clear? Okay. Then we have funds borrowed generally. Now, funds borrowed generally, we use a weighted average of borrowing costs outstanding during the period, multiplied by the expenditure on the qualifying asset. Let's simplify this one as well. You may borrow